Crescent Capital BDC missed Wall Street consensus on both the top and bottom lines for the second quarter of 2026.
Yeah, they reported net investment income, or NII, of 36 cents per share. That misses the 36.67 cent consensus estimate. And I mean, it's down sequentially from 38 cents adjusted in Q1 and 46 cents a year ago.
Revenue took a hit too. Total investment income came in at $36.32 million. Analysts were looking for 37.33 million. So that is a noticeable sequential drop from 37.9 million back in the first quarter.
And looking forward, we did not get any formal quantitative guidance. What we did get was heavily qualitative, focusing almost entirely on the need to deleverage the balance sheet. They want to get it back down to their target 1.1x to 1.3x range during the second half of 2026.
They maintained the 34-cent regular-based dividend, and they are going to pay that second 3-cent special dividend in September. But they will not be paying a supplemental dividend this quarter.
Right. And the market reaction was, well, exactly what you'd expect. Negative. Shares dropped 2.74% in after-hours trading to $11.36. During the next regular session, they closed down 2.05% at $11.44, basically hovering right near the absolute bottom of their 52-week range.
Okay, stop right there. A headline miss is usually just a miss, but with business development companies, BDCs, the headline numbers are basically a smokescreen. To figure out if this drop is a buying opportunity or a falling knife, we need to look at the actual plumbing of the business.
Exactly.
Today's deep dive pulls directly from Crescent Capital's Q2 earnings transcripts, SEC filings, and recent Wall Street analyst notes. Our mission today is to decode whether an 8-quarter slide in asset value is a death spiral or the ultimate value investor set up for you.
Because when you dig into a $1.6 million sequential drop in total investment income, it's never just one thing.
Right.
It's a combination of systemic market conditions and structural portfolio mechanics. The biggest culprit for Crescent this quarter was the dividend income drop. That specific line item fell by 1.8 million sequentially, landing at just 1.2 million. Wow.
Yeah, and this was specifically driven by lower distributions from their Logan joint venture.
Let's translate that for a second. If you're a retail investor holding CCAP, you might see lower distributions from a joint venture and assume, some company just went bankrupt. But that's not what's happening here, is it? Explain the mechanics of this Logan JV.
Right, it's not a default at all. A joint venture in the BDC world is essentially a separate off-balance sheet bucket of investments. BDCs partner with another institutional investor. They pool their capital, borrow some money against that pool, which is the leverage, and buy a bunch of senior secured loans.
Okay.
The income generated by those loans pays off the JV's debt, and whatever is left over gets kicked up to Crescent as a distribution.
So it's essentially a yield-boosting engine bolted onto the side of the main portfolio.
Exactly. But here's the mechanical issue they're running into right now. The Logan JV is currently amortizing and reducing its own leverage.
Okay, so in plain English, the loans inside that joint venture are paying off. Right, and instead of reinvesting that cash into new loans, the JV is using that cash to pay down its own debt.
Ah. So if the joint venture is prioritizing paying down its own credit facility, there is less excess cash flowing up to Crescent Capital BDC as a dividend.
Precisely. It is a structural decline. As the JV shrinks its balance sheet, the cash it kicks up to Crescent naturally drops. It's a healthy financial maneuver for the long-term risk profile of the JV, but in the short term, it hits Crescent's top line immediately.
And if that was the only issue, maybe it wouldn't be a big deal. But they also ran into a massive refinancing slowdown.
Yeah, they did.
The income they make from accelerated amortization and prepayment fees, that income halved. It dropped to $0.4 million. For context, their trailing 4-quarter average for that line item was $0.8 million.
This is a crucial piece of the BDC business model that you really have to understand. When Crescent makes a loan to a middle market company, they structure it with penalties for early repayment. If that company gets acquired by a private equity firm, or, if they find cheaper debt somewhere else and decide to pay off Crescent's loan 3 years early, Crescent gets hit with a windfall of prepayment fees. It's essentially pure profit that flows straight to the bottom line.
Right. I like to think of this like a commercial landlord. What Crescent is experiencing right now is like a landlord losing the premium rent from their anchor tenant.
Yes, the Logan JV distribution's drying up.
Exactly, while simultaneously seeing a massive drop in lucrative lease break fees because tenants just aren't moving around anymore. If transaction velocity in the broader middle market is stalling, nobody is refinancing, nobody is paying those early exit fees.
Which leaves management in a very tough spot. If organic transaction velocity is stalling out, you cannot magically force borrowers to refinance and pay you fees. You have to find a way to replace or defend that high-margin income from within your own operations.
Which brings us to the April 1st announcement. Management implemented what they called a structural expense reduction. They cut their base management fee from 1.25% down to 1.00%.
Right, a straight 20% reduction.
And they also cut the incentive fee from 17.5% down to 15.0%. But wait, let me push back on this. In high finance, nobody takes a 20% pay cut out of the goodness of their heart. What's the catch here? Are they just doing this to keep the stock from completely cratering?
It's not altruism, it's survival math. The management team at Crescent is paid by the broader parent company, but they earn fees off the public BDC based on the assets they manage and the income they generate.
Right.
If that top-line revenue is shrinking because prepayment fees disappeared and the JV is deleveraging, the NII, the net investment income, shrinks. If NII falls below the 34-cent base dividend, the BDC would be failing to cover its payout.
And for a BDC, the dividend is sacred. That is the entire reason retail investors buy these stocks. If you cut the base dividend, the market will punish you mercilessly.
Exactly. So management essentially ran the numbers and realized we literally cannot count on those prepayment fees in a high-rate, low M&A environment. The only lever we control entirely is our own fee structure.
Sure.
By lowering their operating expenses, by taking less off the top for themselves, they artificially boosted the NII just enough to cover that 34-cent base dividend. It's margin defense.
Okay, so they played defense on the income statement, and it worked for now. They covered the 34-cent base with the 36 cents of NII. But you can only play defense on the income statement for so long before you have to answer for the balance sheet.
Yeah, that's the real issue.
And that brings us to the metric that is definitely keeping you up at night. If you hold CCAP in your portfolio, the net asset value, the NAV, this is the mark-to-market reality of their actual loan book, and it is eroding.
It is a stark trend. NAV per share dropped from $18.27 in Q1 down to $17.82.
And let's be clear for you listening, this isn't a one-off blip because of a bad month. This is the 8th consecutive quarter of NAV compression. 8 quarters. A 2-year slide in the underlying value of their assets.
Yeah, and the primary culprit for this quarter's drop was the GAAP net loss of 9 cents per share. To understand how that happens, you have to look at the unrealized and realized losses. Crescent took a $17.7 million hit specifically on non-accrual investments.
Okay, let's define non-accrual really quickly because it sounds like accounting jargon. A non-accrual just means a borrower is in such bad financial shape that Crescent has stopped pretending they're going to receive regular interest payments, right?
Yeah, pretty much.
It's the lender equivalent of a return to sender stamp. You mark the loan down and you stop recognizing the income.
That is exactly it. You are legally required to mark down the value of that loan on your balance sheet to reflect the reality that you might not get your principal back. But here is where the reporting gets fascinating and a little counterintuitive.
How so?
Well, despite taking $17.7 million in losses, if you look at the portfolio health metrics, non-accruals actually declined at cost. They went from 5.7% of the portfolio down to 4.8%, and they did not add a single new non-accrual this quarter.
Wait, so they took massive losses, but the percentage of bad loans went down. How does that work?
Because they finally realized the losses.
Oh.
Realized means they actually restructured the loan, sold it, or converted it to equity at a permanently lower value. It moves off the non-accrual list because the loss is finally locked in. So technically, the default percentage looks slightly better.
But that feels like putting lipstick on a pig. Because if you look at the watch list, the loans that haven't explicitly defaulted yet but are performing below expectations, that list actually grew. It went from 14% to 15% of the portfolio.
Which is a metric you should actually be paying attention to. While they didn't push any new companies into the explicit default bin this quarter, the pipeline of stressed companies is swelling. The pressure in the system is building, not releasing.
And we can't talk about portfolio stress without talking about the First Eagle portfolio.
No, we cannot. A few years ago, Crescent acquired First Eagle's BDC and inherited its entire loan book. They've been trying to clean it up ever since.
Yeah, it's been a drag.
They've whittled it down significantly, from over 70 investments down to just 27 right now. Today, it only makes up about 7% of Crescent's fair value. But those 27 legacy loans are a highly concentrated, persistent source of credit pressure.
And what's wild to me is that This is a localized infection.
Yeah.
You don't see the same specific First Eagle pressure across the broader Crescent private credit platform. It is entirely isolated to this public BDC,
Exactly.
which perfectly sets up management's commentary on the earnings call. President Henry Chung was very specific about how they are handling these 27 bad loans. He called their strategy patiently maximizing recovery.
Right.
He basically said, look, these workouts take time, and we aren't going to rush a bad exit just to clear the books.
Which sounds incredibly prudent on a conference call.
Right, but is it, I have to push back on this narrative, is this actually patience, or is it just a reluctance to rip the Band-Aid off?
Yeah.
Because if you're holding on to 27 struggling legacy investments and taking NAV markdowns for 8 straight quarters, I mean, how long can you drag out these First Eagle workouts before the market completely loses faith?
This raises a fundamental question about the mechanics of distressed debt. When you have a bad loan, you essentially have two choices. Choice A is ripping the Band-Aid off.
Right.
That means selling the loan to a distressed debt hedge fund in the secondary market right now. But because the company is struggling, you might only get 40 or 50 cents on the dollar. That permanently destroys your capital and absolutely crushes your NAV in a single quarter.
You lock in the loss and move on.
Exactly. Choice B is being patient. This means you step in, you sit down with the struggling borrower, you restructure their debt, you maybe take an equity stake in the company, and you try to actively guide them to a turnaround.
Okay.
If you succeed, maybe you get 80 or 90 cents on the dollar back in a few years. Crescent completed 3 of these complex restructurings just this quarter.
But the friction here is time. Turning around a struggling middle market business takes years. Public market investors operate on 90-day quarterly timelines. The 8-quarter NAV slide is literally the price of that patience.
And that shrinking NAV is not just a cosmetic problem. It is actively forcing management's hand on how they run the rest of the business today. Because of the way BDCs are regulated, your leverage ratio is mathematically tied to your net asset value.
Yes, let's break this down because I think a lot of people misunderstand how leverage can suddenly spike even when a company hasn't taken out a new loan.
Yep, it's important.
Think of your leverage ratio like a seesaw. On one side, you have your debt, the money you borrowed. On the other side, you have your equity, your NAV. They need to balance at a specific ratio.
Right.
If the NAV side starts eroding because those First Eagle loans are getting marked down, the debt side suddenly shoots up into the air. You look highly over-leveraged on paper, even if you didn't borrow a single extra dime.
That is exactly what is happening to Crescent. Their debt-to-equity ratio has crept up to 1.42x. Even if you look at it net of cash, it's 1.37x. That is pushing well past their stated internal maximum target of 1.3x.
And the debt sitting on that side of the seesaw is getting more expensive to maintain. They just funded a $50 million fixed-rate note tranche, and that pushed their weighted average cost of debt up to 6.13%.
Yeah.
So let's review the plumbing here. Your top-line yield is compressed because prepayment fees vanished, your cost of debt is rising to over 6%, and your leverage seesaw is dangerously tilted because of legacy bad loans. That is a recipe for a frozen balance sheet.
Which is precisely why Henry Chung laid out very strict constraints on their forward deployment strategy. They cannot aggressively originate new large loans because they simply do not have the regulatory or balance sheet room.
Wow.
By law, public BDCs are capped on how much leverage they can carry. So their strategy right now is to keep new investment hold sizes incredibly small, well below their historical average position size, which used to be around 50 basis points of the portfolio.
So they're essentially just taking tiny slivers of new deals.
Right. They want to maintain their relationships with private equity sponsors and stay active in the market, but without bloating the balance sheet any further.
Just treading water.
Exactly. They're essentially treading water, waiting for visible portfolio realizations, meaning waiting for healthy loans to pay off in the second half of 2026 to naturally bring that leverage seesaw back into balance.
But here is the ultimate takeaway for you, the investor, and this is where the tension becomes glaring. If you are shrinking your new hold sizes and you're halting your supplemental dividends just to fix the balance sheet, aren't you essentially capping your upside?
Yes, you are.
Private credit as an industry is booming right now. The broader Crescent platform, the institutional parent company, committed $2.5 billion in Q2 alone. They deployed $8.7 billion over the last 12 months. Crescent's private arm is out there throwing billion-dollar parties, while the public BDC is stuck at home eating ramen until its legacy Fierstiga loans pay off.
That is the structural trap of the public BDC vehicle. The broader parent platform has fresh capital and institutional lockups. They can attack the current market aggressively without worrying about quarterly mark-to-market NAV fluctuations. The public BDC is legally tethered to its legacy portfolio and the 1940 Act statutory leverage limits. Management's priority has to be balance sheet optimization over growth right now.
Yeah.
If they push growth while over-levered, any further credit degradation could threaten the base dividend. They are choosing safety and alignment through those management fee cuts we talked about over aggressive origination.
Okay, so we've mapped the plumbing. We know why the revenue's dropped, why the NAV is shrinking, and why their hands are tied on new investments. What you had to decide now is how to weigh the conflicting signals around this stock, because there is a massive divergence between what Wall Street is saying and what the insiders are doing.
Let's start with the bear case. The analyst reaction to this quarter was swift and, frankly, highly cautious.
Yeah.
Keefe, Bruyette & Woods, KBW, downgraded the stock from outperform to market perform. They cut their price target from $13 down to $12. The lead analyst pointed explicitly to that 2.5% sequential drop in NAV and the multi-year trend of credit degradation.
8 quarters of asset decay is a really hard trend for an analyst to ignore when modeling future earnings.
Exactly. And Wells Fargo maintained their equal weight rating but cut their price target down to $11. The consensus from the outside looking in is that Crescent's earnings power is fundamentally capped while the company works through these First Eagle workouts and prioritizes deleveraging.
But then you look at the bull case.
Yeah.
And the bull case isn't coming from an analyst spreadsheet. It's coming directly from corporate bank accounts. We are seeing massive insider buying on the open market.
The sheer magnitude here is what stands out. Board member Steven Strandberg bought 85,000 shares. That is nearly $1 million of his own money deployed into the stock.
$1 million. And he's not an outlier. CEO Jason Breaux bought 5,000 shares. President Henry Chung bought 4,500 shares. CFO Gerhard Lombard bought 1,000. When the C-suite and the board of directors are buying the dip in this kind of volume, it sends a radically different message than a Wall Street downgrade.
It is the ultimate indicator of management conviction. Think about the information asymmetry here. Analysts are reacting to the trailing indicators, the 8-quarter NAV slide, the non-accruals, the shrinking margins.
Right.
Insiders who have full, unrestricted visibility into the workout progress of those 27 First Eagle legacy loans are acting on forward expectations.
So this brings us right back to that commercial landlord analogy. Is the building crumbling, or are they just renovating a few empty units before they raise the rent? With the stock yielding roughly 12.4% right now and trading at a steep discount to its net asset value, who is actually reading the tea leaves correctly?
That is the defining tension for this stock right now. The public numbers tell a story of compression and constraint, but the literal cash flowing from the insiders' pockets tells a story of absolute confidence.
Are the Wall Street analysts right to bail on a 2-year NAV slide? Or are the insiders signaling that the First Eagle cleanup is finally nearing a lucrative bottom? It's a classic battle between technical momentum and insider conviction, and it's a dynamic you will have to weigh on your own if you're looking at this space. To make sense of these kinds of deep financial currents, you need to stay plugged in. Follow the show for your daily, no-nonsense earnings coverage, and we will keep unpacking the actual mechanics behind the headlines.